Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into our outlook for the second half of the year. Remember, we started the year with our Outlook report, a bunch of articles. We labeled it Outlook 2026 Rewiring Growth. And what I want to do in this episode as we approach the middle of the year, it's just towards the end of June, is take a look at how things have unfolded related to the various areas where we've offered views or forecasts. How's it going? Are things lining up with what we thought? Should we make a change as we look forward? And so it's just a good time of the year to take a look at that. Let's start with the U.S. real GDP forecast. So this is idea, are we going to see economic growth, a recession, what might happen? Now, of course, so far it's been a good year. The forecast that we had for the full year was that GDP would land between a growth rate of 0.75% and 2.5%. And we, at this point, are going to maintain that range, but also say, hey, we think it could lean a little bit towards the upper end of that range. And of course, this is really fueled by the big, among other things, the big AI build out, right? The infrastructure for AI. So the CapEx spending that's been happening, especially by the hyperscalers. And as we see sort of AI make its way into the environment and the capacity being built to support that. We think that's very, very important. There's a little bit of fiscal support when it comes to one big beautiful bill that's sort of shown itself a little bit uneven, but the consumer on and off again has, generally speaking, remained on again, meaning supportive and one of the drivers of economic growth. Now, a second area that really changed a lot, we were calling for a forecast for inflation. And we're going to up that. We're going to up that to 2. I think we had 2.25 to 2.75. We're going to up that 0.5%. So 2.75 to 3.25 for the full year. And this is specific to the core PCE inflation index. And essentially, of course, not a surprise that we're making that change much for what's already happened, which is the conflict in the Middle East driving up energy prices. Then there's a pass-through effect of higher energy costs making its way into the core area of goods and services that is measured by the core indices, right? And energy itself is not included in core. It bounces around a bit, but these higher costs are input costs to a bunch of other things. And so we've seen inflation firm up a good amount. Now, the good news is we think, as it relates to the environment, to the degree that this fragile peace can continue, and we make our way towards a more formal peace deal, then energy prices fall and we're going to see inflation cool down. So as it relates to inflation, again, we're increasing our range for the full year given what's already happened. Now, the labor market has held up really well, right? So if you think about the focus of the Fed, they need to worry about two things: stable prices, i.e., let's keep inflation under control, and then maximizing jobs, so a good, solid labor market. And when they have that labor market in a good spot, which seems to be where we are, then the Fed can focus more on the prices, i.e., inflation. So there's been a shift where originally, before this Middle East conflict, everyone thought, the Fed's going to keep cutting. We'll probably have 1 or 2 cuts a year. That was our forecast. So we've taken that off the table. Now, we're different probably than many in that a lot of folks in the markets are calling for rate hikes. We think again, assuming peace, that path continues, that the idea of falling energy prices could quickly make its way into inflation and I think equally important inflation expectations. So that's going to get the Fed's attention. So we're kind of in a place where we think the Fed's going to stand pat on their current still restrictive policy and not hike rates further, but we'll see. That's an adjustment. Now, as it relates to the interest rate environment, we have a range now for the 10-year Treasury, and again, this is up a little bit, I think a 1/4 point, to 4.25 to 4.75, and this is really driven by the idea that Treasury rates are higher and they're going to stay higher for longer. Now, inflation has had an influence on that a little bit, but we think another important force is really moderately increasing worries about the federal government, federal debt, how much debt's being built up, and investors, again, everything's still reasonable, but investors just look for a little bit more return given the increased risk. And so the fiscal trajectory of the government translates to a higher term premium, what the investor wants to get paid to invest in that bond for that period of time. That's put up a little bit of upward pressure on rates. So we've, between inflation and that factor, we've upped our forecast just a little bit. Now, another area of fixed income is credit spreads. And so essentially, spreads were tight as we started the year. And without getting into the numbers, we've maintained both our investment grade spread range and high yield spread range, where it's essentially expecting a modest widening, not an alarming one, but basically that spreads are super tight and we think they're going to widen out a little bit. Now turning to the equity market, we started the year with a target on the S&P 500 of 7,450. And so what I would say about that is we've recently experienced increased volatility, various kinds of worries. And so, markets gone up, markets have gone down, but the S&P 500 sits just under 100 basis points below our target. So at 73.54 is where it closed. And I'm recording this over a weekend, so basically on Friday the 26th, right? And so we look at things. We say, look, that was a healthy return for the year if it hits our target. And the bottom line is we just don't feel compelled to change it. We're not overly worried, but we also see the possibility of the market bouncing around a little bit. It's a little bit richly valued. And so even though earnings growth has been great, we're sort of just not compelled to make a change. And so we could underestimate, but I also think there's the risk of, these events, and clearly the peace thing, it could be one where if things become unstable again in the Middle East, market's going to be volatile. And so we're sort of at a place where we think we're going to see maybe a little bit more extra positive return for the balance of the year, but not a big shoot up, and we don't think a big rollover at this point. Anyway, one final comment which relates to the volatility of the market is anytime that S&P 500 moves 2% in either direction, down or up, we publish what we call the market pulse, which is just a recap. We actually do it right after the close. So we want to bring to clients and our financial advisors to use with clients, essentially a two-page piece. It just explains what happened, why it happened, and how that's influencing these kinds of views. And so far in 2026, we've published 4 of those. So that means there's been 4 trading days in the first half of the year that broke that 2% barrier, but we're keeping our estimate for the full year at 15. And so that sort of implies that, we could see a little bit increased volatility between now and year end. So listen, that's really what we wanted to get into, just a kind of a quick pace second half outlook for 2026. Really appreciate you taking the time to listen, and we'll look forward to catching you on the next one. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.